we're going to do these 7 problems. Your numbers will not be different from mine, but it'll be the same problems. Let's start with the information they give us here. Let's see here what I can do. Well, it doesn't matter. Bristol Car Service offers airport service, charges $38 per trip. The variable cost for a trip is $36, and the monthly fixed cost is $602 or $620. So, how do you calculate the break-even point in terms of trips? How many trips it takes to break even? Now, they show here the answer is 310 trips. And notice, excuse me, how they arrive at that. Well, let's put it this way. I will see 36. All of this down here, profit equals, and then starts with 0 and so forth. Fine if you want to do it this way. All you have to do, though, is take the price minus the variable cost. That leaves you $2, and it's fixed cost divided by $2, which means it's 310 trips. Remember this, and again, on the PowerPoint slide, they did show you 2 ways. This is the mathematical algebraic way. The way I think is far simpler and straightforward is simply this. Price minus variable cost is contribution margin. And if it's price per unit minus variable cost per unit, then it's contribution margin per unit. Once you know the contribution margin per unit, you take the fixed cost and divide it by that contribution margin per unit. Again, not contribution margin, but contribution margin for each unit. And that will give you the number of units it takes to break even. Again, fixed cost divided by contribution margin per unit. If one trip is $38, and the variable cost for that one trip is $36, then the contribution margin is $2 per trip, or $2 a unit. That's the contribution margin per unit. But if you want to go through this the way they have it here, fine. I just think it's sweeter and simpler to do it the other way. Now it says, the owner believes that 325 trips is a reasonable forecast. What's the margin of safety? Don't forget the margin of safety is the number of trips above the break-even point in trips, or the number of sales dollars above the number of sales dollars of break-even. So, if it takes 310 trips to break even, and he's talking about average number of trips is 325, well, 325 is 15 more than 310. So you have a margin of safety, a cushion. In other words, sales would have to drop, the number of trips would have to drop by 15. If they average 325 trips, then trips have to drop by 15, have to drop by 15 before you approach the break-even point. And of course, below the break-even point, you're losing money. So a margin of safety is like a cushion. What is the cushion above the break-even point? And that's your margin of safety. Okay? Alrighty. Let's go to question number 2. Yes. Okay. So let's work this out. Anus, I guess that's how you pronounce it, amusement center has collected the following data. Okay, so we see the total revenue, total everything here, right? Okay. So the first question is, what is the average selling price for a ticket? Well, how do you figure that out? The average price? If the total revenues from ticket sales is 1,984,000, and you sell 62,000 tickets, divide one by the other, and you will get 32. So the average selling price for a ticket is $32, as you see here. Okay. Next, what is the average variable cost per ticket? Well, the total variable cost is 1,116,000. You divide that by 62,000 tickets, then you find the average variable cost is $18. And that should be it right there. Yeah. Now, C, what is the average contribution margin per ticket? Well, what is the contribution margin, folks? I just told you on a previous slide. The contribution margin is sale price minus variable cost. Well, we have it in terms of totals. So total revenue minus variable cost will give you, what is it here? Oh, what is it? Contribution margin per ticket. I'm sorry. Well, if the sale price per ticket is 32 and the variable cost is 18 per ticket, then the contribution margin is $14 per ticket. $14 per ticket, right? And let's see. There you go. Sale price minus variable cost is 14. All right. Now, what is the break-even point? And break-even point, they want it typically in terms of the number of tickets in this case. What did I say on the previous slide? Fixed cost divided by the contribution margin per unit, or per ticket in this case, will give you the number of tickets you have to sell to break even. Well, a fixed cost is 652,400. You divide that by 14, and we get the break-even point in terms of tickets of 46,600. You take that 652,400 divided by 14. Now, the way they do it, or they meaning the, see here, again, if you want to do it their way, fine. But you simply have to just take, it's right there, 652,400 divided by 14. Rather than go through all this, once you know the contribution margin per unit, folks, contribution margin per unit, and you know the fixed cost, you can divide one by the other. The last, let's say D, we just did D. E. She says unless she can earn $250,600 in operating profit, she's going to close the business down. So what number of tickets must be sold for her to make that much operating profit? Well, what do I have here on my notes? Okay. All right. We got the fixed cost, right? And you want operating profit of $250,600. What do? You simply add it. You see this down here? The 652,000 is your fixed cost divided by the profit you want to make, or not divided by, plus the profit you want to make. Okay, let me say that again. The total fixed cost plus any profit you want to make. Add them together and divide by the contribution margin per unit, and that gives you 64,500. So she has to have or sell 64,500 tickets in order to meet that profit goal. Again, if you want to go through all of this up here, fine. But to me, it's simply, okay, what's the fixed cost? What's the target? Add them together and divide by the contribution margin per unit. Okay, so we've done that. This is the second problem. Okay. let's go to problem number 3. Okay. Hunter and Sons sells a single model meat smoker, whatever that is. The smokers have the following price and cost characteristics. So $78 per smoker is the sale price. That's what they sell it for. The variable cost is half that, $39. So what's the contribution margin per unit, per smoker, folks? Look at this information right here. What is the contribution margin per smoker? You should know it now. It is the sale price minus variable cost. In this case, $39 is the contribution margin per unit. Okay, and that's your fixed cost. Now, they have a 40% tax, well, which is pretty high. Anyway, doesn't matter. How many smokers must Hunter and Sons sell every month to break even? Well, we know the fixed cost. We know the break-even margin, the contribution margin per unit. Divide one by the other. 280,800 divided by 39. And that gives you 7,200. All right? You don't have to go through all this up here. Profit equal P minus V times X minus F. I mean, no. Ooh. Anyway. Okay, enough complaining. I'll just do it that way. Okay, now. How many smokers must Hunter and Sons sell to earn a monthly operating profit of $65,520 after taxes? Well, we know the tax rate is 40%. Remember the formula? You know you want a profit that you want to make. You know the profit you want to make. Okay? So you're not going to add that to the fixed cost. But since they gave us the tax rate and they're saying that this is what they want to make after taxes, then, okay, excuse me, I dropped something. Anyway, so the formula is fixed cost plus, in parentheses, the after-tax profit you want to make divided by 1 minus the tax rate. So, take a pencil or whatever and write this down. Write down 280,800 plus, open a parenthesis, 65,200 divided by 0.6. Because if the tax rate is 0.40, then 1 minus the tax rate is 0.6. Then close the parenthesis. And then draw a line under all of that and put 39. So you're going to end up with a numerator of $390,000. Okay? Because it comes out to be 280,800 plus 109,200. In other words, 65,520 divided by 0.60 or 0.6 is 109,200. That's what you're going to add to 280,800. Okay? And so that's 10,000 units. And there you go. Okay? And again, they show you that here. At least the first part. It's 109,200. Because if you take 65,520 and divide it by 0.60, which is 1 minus 0.40. That'll give you 109,200. And you add that to the fixed cost, as you see here, and divide it by 39, which is the 78 is the sale price minus variable cost of 39. Okay, all right, 10,000 units. Okay, number 4, we have a mixed or multiple products. This company sells regular coffee and latte. And these are the prices and the variable cost. Okay. Now, the monthly fixed cost is $5,658, and the ratio of coffee sold to latte sold is 80-20. Okay. So in other words, 80% is really a 4-to-1, same thing, 80-20. 80% of the sales are regular coffee and 20% are lattes. So what do? Well, first of all, excuse me, calculate the contribution margin per unit, or per cup of coffee, or per cup rather. Well, for coffee it's 80 cents, right? $1.50 minus 70. For the latte it's 90 cents, $2.30 minus $1.40. So now we know that the contribution margin per cup for coffee is 80 cents and is 90 cents for latte. Now, since it's an 80-20 split, what you do is you take the 80 cents contribution margin per unit and multiply it by 0.8 or 0.80, since it's 80% of the sales. And then you take the 90 cents contribution margin for latte and multiply that by 20% or 0.20. So let's go back. 80 cents times 0.8 is 64 cents, and 90 cents times 0.20, 20%, is 18 cents. So 18 cents plus 64 cents is 82 cents. That's the average contribution margin per unit. Weighted average, actually. It is the weighted average contribution margin per unit. Since now we know the contribution margin per unit, even though it's weighted average, we're going to take the fixed cost and divide it by the weighted average of 0.82. And I'll give you 6,900 cups that you have to, is the break-even point in total. And then you can take 80% of that for the coffee, which is, that'll be 5,520 cups of coffee, and 1,380 cups of coffee for the latte. Okay. And this is how they did it. Again, the way I did it, because I do these problems also on my own, just partly to determine how long it takes me, and then I multiply it usually by 3 or 4, thinking it'll take you that long to do it. Anyway, that's another story. Again, you figure out as you see here, we got this 150 minus 70. That's the contribution margin per unit, and you multiply that by 80% because 80% of the sales are coffee. This 230 minus 140, which makes it 90 cents contribution margin per cup of latte, times the 20%, and that'll give you 64 cents plus 18 cents, which is 82 cents. and you take the 82 cents, at least I did. I took the fixed cost of 5,658 fixed costs and divided by 0.82, and I got 6,900 cups. And then you split that 80-20. 80% of 6,900 is 5,520, and on the other 20% are lattes. Okay. All righty. Let's move on to number 5. Okay. Let me look at my paper here. All right, number 5. Yes. And it's a similar problem. Two models, two kinds of laptop covers, cases, and these are the details. What is the anticipated level of profits for the expected sales volume? Well, here's what you would do. The expected sales volume. 7,000 bags at $60 a bag. Multiply it, you get 420,000. We got the variable cost per programmer bag at $20. So 20 times 7,000 gives you 140,000. So your contribution margin what is the expected sales volume? Oh yeah, okay. All right. That's the programmer bag. The other side, 10,500 bags at $100 is $1,050,000, and then you multiply 40 times that many bags, you get 420,000, which will give you well, the sales volume. Yeah, I'm looking at the next problem about the break-even point. The sales volume, again, as you can see here, there's 232,000, and again, if you take the 280,000 contribution margin plus the 630,000 contribution margin, that's altogether $910,000 in contribution margin, and you subtract the cost, and that will be the profit, 232,000. Okay, so let me go over that again, because they want the anticipated profit, the level of profit for the sales volume. If they sell 7,000, if they sell 10,500 of the executive. Well, we know that profit is sales minus variable cost, which gives you contribution margin, minus fixed cost, and that will give you the profit. So 60 times 7,000 is 420,000, and 20 times the 7,000 bags will give you 140,000. You subtract one from the other, and you get a contribution margin for the programmer bags at 280,000. Set that number aside. We got 105,000 times 100, which gives you 1,500,000. And then you multiply 40 times that 10,500, and you get 420,000. Subtract one from the other, and you get a contribution margin for the executive bag of 630,000. So add both contribution margins, and you get 910,000. Subtract the fixed cost, and you get your profit of 232,000. Okay, and that's how they did the same. Well, yeah, it did the same way I did it. Yeah. Okay. Next, assuming the product mix is the same at the break-even point, compute break-even point. Well, this is similar to the problem we just finished, number 4. First of all, we know the contribution margin per programmer bag is $40, right? 60 minus 20. We know the contribution margin for the executive bag is $60 per bag, 100 minus 40. So, if you take the total number of bags, which is 17,500, the programmer bags are 40% of that. If you take 7,000 and divide it by 17,500, you'll get 0.40. And if you take 10,500 divided by 17,500, you get 0.60. So the programmer bags are 40% of sales, and the executive bags are 60% of sales. So we know the contribution margin is 40%. So 40% of $40 is $16, and 60% of $60 is $36. So 36 plus 16, your weighted average is $52 is your contribution margin. Your weighted average contribution margin. And you take the fixed cost, 678,000, divided by 52, and we get 130,000. What did I have? I'm trying to read my writing here. What is that? 13,038.47. Yeah, 13,039. Yeah. 13,038.46. Would they round up to 13,039? Okay. The answer to problem B is you solve it the same way we just did with problem 4. You figure out the contribution margin for each item and then determine what percentage of it is, or you find a weighted average of the contribution margin. Okay, and of course that was also presented in the PowerPoint slides too. Okay, in fact, let me show you how they did it. Yeah, you see they say 7,000 plus 1050, that's 17,500. So 7,000 divided by that total and 10,500 divided by the total gives you the 40% and 60%. And since the contribution margin for one bag is $40, 40% of that is $16, and 60% of the $60 is $36. Add them together, that's your weighted average contribution margin. You take the fixed, and then just skip all this stuff down here, and simply take the 678,000 divided by 52, and you'll get 13,039 bags. And then multiply it by 60 again, and that's how many units to break even per bag. Okay. Now let's see here. C, yes. C says if the product sales mix were to change from 9 programmer style bags for each executive style bag, what would be the new break-even volume? Well, there'll be a 9-to-1 ratio, right? 9 to 1, which means that 90% of the sales, rather than 40% of the sales, 90% of the sales will be programmer and 10% will be executive, a 9-to-1 ratio. And then you take 90% of the $40 contribution margin for the programmer is $36, and 10% times the $60 contribution margin per executive is $6. So 36 plus 6 is 42. That's your weighted average contribution margin. Then you take 678,000 and divide it by 42, and you get 16,143 bags. And there you go. Okay. And then this is how they did it. And then you split the 90-10 again to get the individual units per bag. Okay. Alrighty. Now, number 6 brought me back to what we learned in managerial accounting, 1820. But they didn't use that method here. But let's take a look at what they did here, what they asked us here. They asked us to compare two companies' cost structures. Spring Company has a contribution margin ratio of 0.45 with fixed costs as $103,500. Winters has a contribution margin ratio of 80% versus the $345,000 fixed cost. Okay, and they both have the same level of sales. Well, remember what contribution margin ratio is? It is the contribution margin divided by sales. That is your contribution margin ratio. Okay. Again, which means that if the contribution margin is 45%, then the variable cost must be 55%. So let's take one company at a time. The sales are the same, so 690,000. Now 45% of that is your contribution margin. So if sales minus variable cost is contribution margin, and if contribution margin is 45% of sales, then the contribution margin must be $310,500. And the difference between the two will be your variable cost, because sales minus variable cost is contribution margin. Sales minus variable cost is contribution margin. If you know two of them, you can figure out the third one. We know the sales is 690. We know the contribution margin is 45% of that, which is 310,500. So the variable cost must be 55% of that, or 379,500. So now we have sales at 690,000. Variable cost is 379,500. Subtract that from the sales, and you get a contribution margin of 310,500. And you subtract the fixed cost of 103,500. All right, and you get an operating income of $207,000. That's for spring. Now let's go to winter. Same number of sales, and it's what is it here? Yeah, contribution margin is 80%, which means the variable cost must be 20%. Right? So 690,000, 20% of that is $138,000. So 690,000 minus 130,000 is 552,000, and 552,000 is exactly 80% of 690,000. So now we have sales of 690,000 minus variable cost of 138,000, which gives you a contribution margin of 552,000. And if you subtract the fixed cost of 345,000, you also get the same operating income of $207,000. So what do you notice here? That where one company has a higher variable cost, the other company has a higher fixed cost, and they come up with the same volume. Now, suppose that both companies experience a 15% increase in sales volume. By how much would each company's profit increase? Now, there are two ways to do this. You could simply say, okay, I'm going to multiply sales by 1.15, that's a 15% increase, and multiply variable costs also by 1.15. Don't forget, variable cost goes up and down with total cost, right? Total variable cost goes up and down with volume, sales volume. So you would multiply 690,000 by 1.15. You'd also multiply fixed variable cost by 1.15. Fixed cost stays the same, and so you do your subtracting, and you'll come up with the difference between 207,000 and the new amount. And you do the same for the winters. Or you could go back and remember what we talked about in detail, though this book did not discuss how to use what are called degree of operating leverage. The textbook mentions it, but it does not tell you what the textbook in 1820 mentions. And that is, once you know the degree of operating leverage, whatever that is, if you multiply it by any percent of increase, they'll tell you what the sales will increase or the profit will increase by. Let me put it this way. Degree of operating leverage is contribution margin divided by operating income. So if you take the contribution margin for spring at 310,500 and divide it by the profit of 207,000, you'll get 1.50. And any kind of percentage increase in sales will tell you what the profit will increase by. So 1.50 times 0.15 equals 0.225. And if you multiply 0.225 times 207,000, you'll get 46,575, which is the increase in profit. Okay? Yeah, we just did this for A, and this is B, 46,575. By the same token, if you refer to 1820, if you take the contribution margin for winter at 552,000 divided by the profit of 207,000, you get 2.667. Multiply that by 15% and you get 0.40. And take 0.40 multiplied by 207,000 and you get 82,800. So the two ways to come up with this, some of you may remember, if you, and I'd be impressed, really impressed if you did. This stuff is not easy to remember unless you do it back to back and really love it, I guess. But here's how they did it, and it's probably simpler, but I did it the other way. But all you have to do is you multiply. You see, they took the 15% increase and multiplied by 0.45, which is the operating the ratio, or contribution margin ratio, and they did the same thing on the other side. So it's a quicker way of doing it, probably. That's just not the way I did it. I guess, you solve a problem, what comes quickly to you or easy to you, I suppose. or quicker. So you can do it this way. I don't know if you want to do it the way I talked about, the way we learned in 1820, by using the degree of operating leverage. But there we go. Okay. Let's do our last problem here. Last problem is more involved. And I won't give you something as detailed as this, but I like it because it is involved. I'll give you probably something similar, but I liked it. I just put it that way. So here we have all this detail, and you got to pay attention and read very carefully, folks, or you'll be thrown off and make a mistake. Shows, that's how you pronounce it, shows or skulls. They sell two types of office chairs, and no, they sell one type of office chair. Okay, yeah. Fixed cost $1,560,000. They sell 96,000 units at $60 a unit, and the variable cost is $30 per chair. And so I just took that. The first thing I did after reading the entire problem is I set it up to see, okay, under that, with that information, what kind of operating profit are they earning? So if you take 96,000 times 60, you get 5,760,000. And if you take 96,000 times the $30 in variable cost per unit, you get $2,880,000, which is half. So the contribution margin is $2,880,000. You subtract your fixed costs from that, and you have an operating profit of $1,320,000. Just from that first part. Okay? I just explained to you how I would do it, and if we were in class, that's what I put on the board. Okay, where am I? Yeah, the production engineer said, okay, we know we got $30 per unit of variable costs. And so I took that $30, all right, and it said that 60% of that is labor. So 60% of 30 is 18. And 20% is from materials. So 20% of 30 is 6. Okay? And the rest has to be overhead, variable overhead. You just figure that out. Don't forget, you have, on the variable cost, you have 3 components: direct labor, direct material, and variable overhead. So if you know 2, you can figure out the third one. We know that out of $30, what did they say? 20%? No, was it? No. What is $30? 60% was labor. 60% of 30 is 18. 20% of 30 is 6. So the rest has to be overhead, which is another $6. So that variable cost consists of $18 of direct labor, $6 of direct material, and $6 of variable overhead. Variable overhead. Okay, so we got that. It's important that you do that. Then they talk about the increases. Where is that? Variable overhead cost. Variable overhead expected to increase by 25%. So you take 6 times 1.25, right? Because 25% increase. So it's going to be $7.50. It'll go from 6 to $7.50. The material cost, direct material, I'm trying to see where it is on here. Direct material going to increase. 20 by 20%. So Is it? Let's see. No. I'm trying to see here. I'm reading this. Oh, labor cost is going to rise by 20%. So you're going to take 18 times 1.20, and I'll take it to $21.60. Oh yeah, and material costs will rise by 5%. So multiply that by 1.05. So 6 times 1.05 will give you $6.30. So now, let's recap. Labor is going to increase from $18 to $21.60. Material is going to increase from $6 to $6.30. And overhead is going to increase from $6 to $7.50. So altogether, variable costs are going to increase from $30 per unit to $35.40 per unit. Okay? Okay. And they mentioned sales can't increase by more than 10%. So at one point we're going to say it's $60. So 1.10 times 60 is $66. And your fixed costs will increase by what, 6%? So your fixed cost times 1.06 will be $1,653,000. Okay. We need all that detail to be able to answer the following questions. Compute the volume in units and dollar sales level necessary to maintain the present profit level. Well, we already calculated the present profit level, right? And one of the first things we did. Well, I shouldn't say we. I hate people say what I did, and hopefully you will do. So the operating profit is $1,320,000, right? So if we want to keep that, given these increases in cost, given the increases in fixed costs and variable costs, what do we have to do? How many units must we sell at $66? Let's increase that too, but we want to keep that same operating income of $1,320,000. Yeah, we're going to increase the price, but also our costs have gone up. Also, we still want to come away with $1,320,000 of operating income. So what do we have to do? How many units must we sell? Here's what is interesting. The way I did it. I wrote down sales, under that variable cost, under that contribution margin, fixed costs, and operating income. Okay? I know my operating income is going to stay the same, $1,320,000. So I write that down. And I draw a line above it. And fixed costs, we know it increased by 6%. So now fixed cost is $1,653,600. So what's your contribution margin? You add those two together. Don't forget, if you know two, you can figure out the third one. See, contribution margin X minus fixed cost of $1,653,600 gives you an operating income of $1,320,000. So the contribution margin total must be $2,973,600. Prove it. Write it down, folks. If your contribution margin is $2,973,600, and you subtract the fixed cost, which we just figured out, of $1,653,600, that will give you the operating income of $1,320,000. But here's the thing we need to do. We know the contribution margin is now $2,973,600. We now know that the new contribution margin per unit is $30.60. How do we figure that out? Well, the new price, don't forget, contribution margin per unit contribution margin is sales minus variable cost. That gives you contribution margin. If the new sale price is $66 and the new variable cost is $35.40, what we figured out with these increases, then the new contribution margin per unit is $30.60. So if total contribution margin is $2,973,600, and if we divide it by the unit cost, that means it must be 97,177 units. Because $30.60 times 97,007, let me back up, excuse me. $30.60 times 97,177 will give you what? It'll give you the number of units that we're talking about here. We had to back into this. We had to do some critical thinking. Okay, do some problem solving. If I tell you X and Y, you can figure out Z. If I tell you A and B, you can figure out C. So let's go back. If contribution margin is $2,973,600 and the new variable cost per unit is $30.60, then the number of units must be 97,177. And that's what we have right there. And the sales would be that times $66. Okay? Times $66. Okay. This is a nice problem. I like this one. Let's see, B. Compute the sales volume and sales in dollars. Compute the volume of sales and dollar sales level necessary to provide 7% increase in profits, assuming that you increase the price also. Well, what did we want? We wanted a 7% increase in profit. So what do? The profit right now is $1,320,000. We want a 7% increase, so times 1.07. And so we want a new operating income or a new profit of $1,412,400. Right? Fixed cost is the same, the increase of $1,653,000. Add those two together to get the contribution margin of $3,065,400. And if you divide that by the new contribution margin per unit, you will get, I want you to do it yourself, you'll get 100,177 units. And you multiply that by 66, and you're going to need to sell 6,611,648. Now their numbers are a bit different because of rounding, apparently, because yeah, I get 100,177, and that throws off the volume and sales by about 2,000. And it has to do with rounding because and the method they're using. So I differ with them by what? Let me see, we got that. We got the same here. 1,412,400. And the same fixed cost. The 3520. Okay, 3540 rather, will give you 3060. So it has to be a rounding error because I got the same numbers they have there. I just backed into it. They use a formula, but you get the gist of it. Once you know the contribution margin total, and if you divide it by the contribution margin per unit, then you get the number of units that you have to sell. Okay. And with C, all you have to do, if you kept it at 96,000 units, you didn't sell any more units than 96,000, but you wanted that 7% increase in profits, you gotta do something with the price. The price has to go up. Well, what you do is you take the new sales volume that you have to have and divide it by the 96,000 units, and that'll give you the $68.87 was what I got. They got $67.34. And again, folks, if you come this close, then I won't mark it wrong. But the point I want to make is that that's how you would do it. See, what they did, they went through all this. My point is that if you know the sales volume you need to have, and you can only sell 96,000 units, divide one by the other. Okay. All right. So this, and then I got to go through chapter 4 with you, but this is chapter 3, and I'll be sending this over shortly. Not shortly. Take some time to do it. It'll take a while.